Welcome to Bixin's Daily News. Today is the 15th of September 2022. We'll be covering patterns of crypto exchange launches, crypto adoption index, Opensea, and lastly, issues surrounding VeToken. Let's get to it. On September the 15th, the Block Research published a research report titled Analyzing Patterns of Crypto Exchange Launches. As opposed to previous bull runs, number of exchanges launched in crypto is no more correlated to the increase in total market cap of the industry. This could be a result of the sophistication of existing players in the market and evolving regulations in several jurisdictions. Growth in the amount raised is significantly more than the number of funding deals in percentage terms, thanks to 9-figure raises by exchanges like Binance and FTX. Exchanges are more sophisticated, user experience has improved, more consumer-centric products and services have been developed, making it more difficult for new players to enter the market. As nations are presenting more stringent regulations for crypto assets, selective business licensing to crypto services has also caused a decrease in number of exchanges entering the market. With increasing recognition from retail and institutional investors, governments are making a concrete effort to create regulatory frameworks for digital assets, thereby validating the crypto movement. In the last 3 years since our previous analysis, China's decision to ban crypto forced native exchanges to shut down or shift their HQs elsewhere. Singapore saw a 220% rise in number of exchanges launched. The number of exchanges established in Seychelles increased from 3 to 17. Ideally, policymakers will want to balance tightening rules for crypto services and their seamless integration with TradeFi. If countries cooperate to avoid regulatory arbitrage and promote universal guidelines, we'll be a step closer to a more efficient global financial market. On September 14th, Chainalysis team published a research report. The following is part of the content. Overall adoption slows worldwide in bear market, but remains above pre-bull market levels. Our data shows that global adoption has leveled off in the last year after growing consistently since mid-2019. We look at this trend in the chart below, where we apply our index methodology globally by summing all 154 countries' index scores quarterly from Q2 2019 to the present, and re-index that number again to show adoption growth over time across the world. Global adoption of cryptocurrency reached its current all-time high in Q2 2021. Since then, adoption has moved in waves. It fell in Q3, which saw crypto price declines, rebounded in Q4 when we saw prices rebound to new all-time highs, and has fallen in each of the last 2 quarters as we entered a bear market. Still, it's important to note that global adoption remains well above its pre-bull market 2019 levels. The data suggests that many of those attracted by rising prices in 2020 and 2021 stuck around and continue to invest a significant chunk of their assets in digital assets. That also aligns with our previous research showing that cryptocurrency markets have been surprisingly resilient through recent declines. Big long-term cryptocurrency holders have continued to hold through the bear market, and so while their portfolios have lost value, those losses aren't locked in yet because they haven't sold. The on-chain data suggests those holders are optimistic that the market will bounce back, which keep market fundamentals relatively healthy. Emerging markets dominate the global crypto adoption index. One trend we noted last year has only gotten stronger this year. Emerging markets dominate the index. Users in lower middle and upper middle income countries often rely on cryptocurrency to send remittances, preserving their savings in times of fiat currency volatility, and fulfill other financial needs unique to their economies. These countries also tend to lean on Bitcoin and stablecoins more so than other countries. Over the coming years, it will be interesting to see what solutions the cryptocurrency industry can build to increase adoption in high and low income countries. As we noted above, while growth has become more sporadic with the onset of the latest bear market, global adoption remains well above the levels that preceded the 2020 bull market. The data suggests that a critical mass of new users who put capital into cryptocurrency during periods of price growth tend to stay even when prices decline, allowing the ecosystem to consistently grow on net across market cycles. One reason for this could be the value that users in emerging markets get from cryptocurrency. These countries dominate the adoption index, in large part because cryptocurrency provides unique, tangible benefits to people living in unstable economic conditions. We'll explore these dynamics more in the full report. On September 13th, Opensea published a blog titled, "Why We Don't Mind the Dips." The following is the main context of the text. The recent market conditions have affected almost every sector, and Web3 is no exception. Of course, since NFTs are denominated in cryptocurrencies, crashes in the market have an impact. In fact, the year we started building Opensea, the price of Ethereum dropped from $1,300 to $90. But a closer look at the data tells a more nuanced story. For example, our volume is still 10 times higher than it was in January 2021, and 40 times higher than it was 24 months ago. And between August 2021 and August 2022, monthly on-chain participants in Opensea grew more than 80%. While the excitement of late 2021 and early 2022 was great for the platform and community, we can't lose sight of the long-term promise and trajectory of NFTs. It's important to separate our long-term vision from short-term market volatility. There is still a lot more work to do, but integrating NFTs into established ecosystems means accessing markets such as the $500 billion gaming industry or the $50 billion ticketing industry. In the long term, the addressable market for NFT creation and consumption is basically every single person on the planet. Big dreams must be coupled with patience and persistency. Changes this massive takes time. Right now, the first NFTs, such as PFP projects, collectibles, and generative art, may feel small, or even like toys, and the use cases many of us dreamed about, like ticketing, gaming, music, and real estate, are still in their infancy. But we know that much more is coming, and we're using today's cases to build our foundational infrastructure for the future internet economy. These foundational bets will build a virtuous cycle among projects, buyers, and sellers. They are the bricks that will allow rapid innovation, creativity, and experimentation as we move into the next phase of NFT evolution. Not only is Opensea used to bear markets, these are the conditions that made us what we are today. We have a huge opportunity in front of us, and our long-term vision makes it possible to separate good ideas from hype, builders from speculators, and signal from noise. During this winter, I expect that we'll see an explosion of innovation and utility across NFTs. On September the 15th, Gab, a member of the Gauntlet network, expressed his views on VeToken on Twitter. The following are his main points. V-Gauges is objectively a bad mechanism to implement for your protocol. It doesn't solve any problems while creating massive ones and needs to go away. First, explain what V-tokens are. Token holders get to lock tokens for some period of time to receive V-tokens, then use these V-tokens to vote on token emission distributions. Why do protocols do this? Two reasons. Number one, protocols need a decentralized way to allocate token emissions. Two, protocols need a way to get people to stop dumping their tokens, causing prices to go down. Now, here's the issue. V-Gauges suck at accomplishing both. The core reason is that there is an incentive misalignment between V-token voters and the protocol. The largest LPs also tend to be the largest token holders. Those LPs vote to pump the pool that they're LPing versus the most productive pools for the protocol. V-Gauges also fails to solve the first problem of efficient token allocation. But what about token price? Are the failings overcome by creating massive illiquidity for tokens, causing token prices to go up? Maybe V-Gauges model redeems itself as a driver of token value. Why doesn't V illiquidity raise prices? Because lockup periods doesn't work. Traders who want to sell your token will refuse to lock up. The only locked up token weren't going to be sold in the first place. You're incentivizing the illiquidity of already illiquid tokens. These are good ways to direct incentive emissions, such as gauntlet networks. There are good ways to prevent dumping of tokens, such as reduced spend. V-gauges solve neither of these while misallocating tokens on useless liquidity pools. V-gauges is just objectively a bad idea.
To continue hearing more, please subscribe to beachingventures.substack.com for a daily newsletter and follow Twitter account Beaching Ventures to hear the rest. This is Celine from Beaching Ventures. Thank you for listening, and we will see you tomorrow.